All right, beautiful people, welcome to the Hit Boss Options Mastery from guessing to controlled execution. This is going to be an all-encompassing course on options, all there is to know about options, starting with the basics, digging a little bit deeper. But if you're new to options, this is a great one for you. If you're experienced in options, this would be a great refresher. Might pick up some new things and learn a few new things. So, welcome. I am the pit bull of Wall Street, aka the pit boss, and appreciate you guys joining me today. So, what options really are? So, options were really built for leverage and risk management. They were not built to gamble. Granted, they are currently being used as that a lot of the time, and mostly noobs to options are going to be the ones using them to gamble. Some of us degens as well, occasional gamble moves. But we have some, I want to say successful ways of gambling with options, but there's ways to use them to reduce risk on riskier positions that could be perceived as a gamble but are not. But maybe that's more like if you're unfamiliar with them. I'll get into it once I get into it. But basically, they're going to give you big exposure. So you can use less capital to have the same amount of exposure. For example, instead of buying 100 shares of Tesla, let's see, Tesla's what, $400 right now. 100 shares of Tesla is like 40 grand. Instead of that, you can buy an options contract and get the same exposure to still get the moves from Tesla. So you can still get the benefit of Tesla going up without spending all that money. So it's not a lottery ticket, it's a weapon. And what we give you is the precise entries. We define the risk, use the option as your max loss. You can use stop loss in your option trading, but um, I do like to use them kind of as my stop loss. So if I'm buying an option for $100, the most I can lose is $100. Easy, right? And there's much higher potential, bigger income potential for sure, and a lot of different ways you can utilize and use options that most people don't know about. Gives you a lot of control, and control is power, but ignorance can be expensive. So what options really are? So options were built for leverage and risk management. And I kind of went into this in the last slide. It's a little bit of a repeat of the last slide. I think that's probably why they both said two on top. I think I made a double. My apologies, but you got it from there. So rooted in history. So one of the old stories of the first options contract, where it came from the tulip. What do they call it? What they call like a boom or whatever. But it's kind of like the first of like the internet booms and all these booms that came out. So the tulips were extremely rare and extremely expensive back in the 1600s. And I believe it was because they had to grow underground for a certain period of time. Excuse me if my story here isn't perfect, but I believe it's because they had to grow underground for a period of time. And therefore, if you wanted to buy tulips, you had to wait a certain amount of time to buy them, but they were in very high demand. So what happened was people would want to buy them so bad, they'd want dibs on them. But the tulip producers would also want the guaranteed income to know that they're going to sell or that they're sold before they even grow them in the first place. So what they would do is they started using kind of like the first options contract. Now, it's not exactly an options contract, but it's the same concept um, as an options contract. And basically would give you the option to be able to buy a tulip bulb at a certain date when it would have been ready at a certain price. So if tulips were going for $100 today, and you wanted to buy a tulip bulb in a few months from now, but you didn't know they might be $200 a few months from now, you'd want to get in on that contract now so you can lock in your price. It's the same thing that options do for stocks, or at least call options in this case. Whereas a tulip producer would more want a put option because they want the ability to sell. Let's say they have tulips growing right now and they're counting on the income from these tulips to be $100 per tulip. So if tulips go up to 200, great, but if they go to 50, it could screw them. So they want to make sure they lock in the sale of the tulip at a certain price. They could do that through essentially like a put contract or through selling an option contract, a call contract. So why trade options now? Same thing we keep saying. Leverage, risk management, and then there's other ways you can use them too to actually have income. You can use them to hedge your portfolio. You can use them as just quick trades. I know I trade futures as well, but when I'm trading options. So if I wanted to short the NASDAQ right now, the NASDAQ's been ripping week after week after week. It is going through the roof. And if I bought or if I shorted futures on the NASDAQ right now, I could risk an insane loss if this thing keeps going. That being said, it's looking like it might be kind of tapped out here, and I can get an options contract on a similar position with similar exposure, similar leverage for a couple $100. So let's say I pay $200 for the option to short QQQ, which is the fund for the NASDAQ, instead of shorting NQ. And then NQ and the NASDAQ and QQQ just keep going straight up. I'll lose that $200. But compare that to if I shorted the NASDAQ right now via a futures contract and it just keeps going up. I'm going to lose $200, then $400, then 1,000, then 2,000, then 4,000, and that loss is just going to keep increasing. Whereas if I just did it by buying an options contract, that the amount that you pay for that options contract is the most money you will lose. So it provides a lot of safety in that aspect when trading at more risky position and stuff. So you don't necessarily have to always use a stop loss if that's kind of your thesis. And my thesis right now is that we're getting overextended and we're going to tap out. I'm willing to risk it and just buy it with the premium. And if I win, I win. If I lose, I lose. But that way, if it does wick up real quick and then crash down, I won't get stopped out right before the move, things like that. So there's lots of benefits to options, risk management, leverage, and income I will get into. Income is a very awesome part of options and the way that you can use options. So now there is a dark side, of course. There's always a dark side to everything this great, but they're a powerful tool, but real risk. You can't lose 100% of that options price. So, well, I can't lose any more than that, so that's good. You can lose 100%. So it's not like buying, well, in a stock you can lose 100%, but if you buy a share of Apple, chances are you're not going to lose 100% of investment. You might lose a little bit here, gain a little bit there, keep it moving, right? But if you buy an options contract on Apple, if you bought a call and it hasn't hit that price by the expiration and it's about to expire that day, you lose 100% of the cost of that options contract. It can be a little bit addicting because we do get a lot of money very fast, big action, big swings, and people get emotionally invested in that and they get that degen vibe going, get addicted to it. They just want more, 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 more. And then you end up crashing pretty quick. So also, you can be right and still lose. So because options contracts have the strike price option to choose from, let's just say I think Tesla's going up. Let's use it better. Let's say SPY. I think SPY is going up. So I buy an options contract a few dollars higher than the price of SPY right now. And SPY goes up only $1, but I bought the options contract at $2 higher than that. So actually, the real example down here is way better. So let's just say SPY is 710 right now, and I think it's going to keep going nonstop. And so I buy 720 calls, thinking it's going to go to 720. Now I was right, and SPY goes up super hard, super fast, straight to 719, and these options expire today. Well, those options are worth absolutely nothing, even though I was right. Whereas if I would have bought just one share of SPY, I would have made $9. If I bought an options contract for 720 on SPY, I would have lost 100%. So that's the downside. Well worth it in my opinion. And once you get to use them, they'll really see that, especially on underlying stocks and things of that nature to avoid some risk. But calls expiring worthless are a real risk. Being addicted to the fast wins and the big money gains is a real risk. And being able to be right and still lose it all is a real risk. I'm going to close my window real quick so y'all don't have to get freaking birds chirping. Oh, my window is closed. I think there might be birds building a nest in my attic. That shit is loud as hell. Sorry. Oh well, listen to the birds with me. So for those of you just getting into options, quick options, basic terminology overview. So you have a call, which is the right, not the obligation to buy a stock at a strike price before the expiration. So if I have a SPY call and it is a $700 SPY call that expires on Friday of this week, today's Tuesday, I would have until Friday for the price to go above that and I would make money. Or if it just went up in value, that options contract would be worth more money today even. And let's just say SPY is 730 on Friday when it expires. Well, now I have the option to buy 100 shares of SPY at 720 because I have a 720 call. Same thing in the reverse with a put. So if I had a $700 put and SPY goes to 690, I have the right, not the obligation, to sell SPY at 700. Therefore, I would make the difference, and it's always times 100 shares. So the contract's always going to be for 100 shares with, I don't want to say always, because sometimes the stock split happens and weird adjusted, so 99.9% of the time it's going to be for 100 shares. And so times everything by 100. If my put was $10 in the money, so I have a $700 put, and SPY goes to 690 on expiration, that put would be worth 10 times 100,000 bucks, right? The strike, when we say strike, that's the price at which, so the 690 put, 690 would be the strike. That's the price at which you have the right to buy or sell the stock. Expiration is the date on the contract. When the contract expires, it's worthless after that. The premium is the price paid for the options contract. So if I'm paying $100 for a contract, it's $100 in premium. Naked, if you hear say the word naked, it just means an option is sold without owning the shares or without owning another option to go with it. So like if I buy a $700 call and I sell a $750 call, those aren't naked because it has the opposite paired with it. Or if I own 100 shares and then I sell a covered call on that, that's not naked because I have the shares, the underlying paired with it. Naked is more high risk because if you lose everything you get with that naked option. It's also more high reward because you get all the upside as well. Credit, when we're talking about credit, that's the money that you receive when you sell an option. So you can sell an option without even having to own the underlying. We'll get to that. So some people make money selling options, some people make money buying options. We do both. Debit is the money that you pay when buying an option, an option spread, and spreads are a defined setup where you're buying one option and selling another, selling one option, buying another. There's some space in between. So learn these terms, master the game, don't get confused. Keep it simple though. We'll dive a little bit deeper into some of these. So calls gives you the right to buy. So with this example here, you have a strike here. Anything below the strike is worthless at expiration, but ahead of expiration, you're paying for that time premium. So the time is really what you pay for. Options are a lot like an insurance policy. So when you buy an insurance policy on your house, there's a premium involved, but then if something happens, you get that money back. Well, it's kind of the same with options. So if everything were to just stay the same, the premium that you paid for the option wouldn't be worth anything. The insurance money that you pay for your insurance on your house each month, if nothing happens to your house, it's not worth anything. But when something does happen, definitely comes in handy. So if you have a call option to buy a stock at $1 and the stock never goes to $1, then nothing happens except you lost the money that you paid for the option. But if the stock goes to $2, then you made a ton of money because you make the difference there. So it gives you the right, a call specifically gives you the right, not the obligation. So that means on the expiration date, if I own the call, I am allowed to purchase 100 shares of the stock for the price of the strike. So if it was a $1 strike on a stock that was worth $2, even though that stock was selling for $2, I would still have the right to buy it for $1, which would give me $100 worth of value there because the difference in between is for 100 shares. So you use calls typically when you expect the stock to rise. And if the stock goes above the strike at expiration, then your call is in the money. You call it, it has value. Now, before expiration, it'll almost always have some form of value because there's value in the potential in it. So you're paying for the premium and the time before expiration, and you're paying for the difference in the strike and the actual cost of the underlying at expiration or near it. Puts is the exact opposite. It just gives you the right to sell. So a put gives you the right to sell, not the obligation to sell shares at a set price. So use these when you expect a value to drop. So for example, if you have a $10 stock and I think that it's going to $5 or going to $0, it's just a trash stock that's way overvalued or whatever, I could buy a $10 put, and then when it goes to $9, since it gives me the right to sell 100 shares at $10, that would give it $100 value if it expired there. Now, if it goes down way before expiration, which it almost always does for us, or whatever position may be, it'll go up if we're in it before expiration, go down before expiration. We're usually not holding options till they expire. We do trade zero DTEs, but those are faster trades, so it's different too. But you use a put when you think it's going to drop. Below the strike is value at expiration. It always has value before expiration because you're paying for the time. It's like always, so way crazy, way crazy. So calls versus put, just know when to use each. Calls is when you expect the price to rise, gives you the right to buy before expiration or on expiration. Profits if the price goes above the strike, and you have unlimited profit potential. So that's a cool part of it. You know, if you buy a call for $1 and the stock goes to $100, you know, you just made $9,900, right? Puts, exact opposite, gives you the right to sell. Profit goes below the strike, limits the risk and protects positions this way too. Also, you can buy puts. Some people do them just to hedge. You know, maybe you own 5,000 shares of Apple. If you do, congratulations, first of all. But and we're coming up on a Fed meeting and war with Iran and Apple's earnings, and you're afraid that Apple might crash and burn for the next few months, even though you believe in it long term. So you want to hold on to the shares. So you can hold on to those shares, buy a put, and then that way, if it goes down, you still make some money on the downside with that put while still owning the under. Alternately, what's even better to me, which a lot of people might get confused by, but I'll just drop it here as a little gem starter. Instead of owning the shares of Apple, if you sold puts on Apple, you can sell what's called cash secured put. That gives you selling someone else the right to sell you the option, which essentially gets you paid for putting in a buy order at that price. Just you're obligated. So that's it. So a few simple option strategies to start with, if you'd like. Real beginner-friendly strategies. Covered calls, by far the most simple. So if you own 100 shares of a stock, you can sell somebody else a call. That gives someone else the right to buy it at a certain price. So let's just say you own 100 shares of Tesla at $400. You could sell every week someone else the right to buy Tesla at 420. And if it never goes to 420, you would make that money on the call premium that you sell every single week. Now, if it does go to 420, you're going to be obligated to sell your shares for $420. And that's even if it goes to 450, you still have to sell at 420. So that's the only downside. But if you got it at 400, you're making money on the premium from selling the option, and you're making money on the difference there in the strike and where you got it, or Apple, I guess, is the example that we used here. But all the same. So protected puts would be if you own the stock, you could buy puts to protect it. That's actually what I just discussed with Apple. And then cash secured puts would be a way that you could sell someone else the right to sell you something. So if I sell you a put, I'm selling you the right to sell me 100 shares at that price. So essentially, I'm getting paid just to be willing to buy that stock at that price. So if I want to own Tesla at $400, I could sell someone else the right to sell me Tesla at $400 on Friday and get paid just for being willing to buy Tesla at that price. But if you keep it simple, manage risk, and stay disciplined, these three basic, simple strategies can definitely give you some good results right off the bat. I think that's the same side of the dice again. I guess I got a little excited. But so why most traders lose is they focus on direction only. That can get you a little bit tied up here if you don't know what strike to buy, you don't know what expiration to buy, and you're just thinking, oh, it goes up, I'm going to buy a call. But you got to learn things like Theta. The Greeks, Theta is time decay. So, like I said, when you buy an option, you're paying the premium for the time. So as that time goes away, the option value gets less and less, unless it's moving in your direction, in which case the strike and entry there at the end would be the best. But then Vega is a change in volatility. So one thing I've done well with over the years is just buying options at a time when they're less volatile and then waiting for markets to get more volatile. This is one time where just the Vega alone can add to the value of an option. So for example, if you know Tesla has earnings next week and you buy Tesla calls a few weeks out, last week, then those calls will be worth more, even if the price stayed the same, just because the expectation of more Vega and more volatility was going up. So that can help you there. But you got to focus on positioning. You got to know the right strikes, entry times, all that. And I think I went over a little bit in the beginning how you can still be right. You can be right and still lose money, right? So these are the Greeks. You don't have to memorize these. You don't have to overcomplicate these, but they're good to keep in your back pocket and to learn and get used to over time. Theta is time decay. As time passes, options lose value. Vega is volatility impact. As Vega increases, options value increase. It says the enemy is low volatility, but that can be a friend for buying. Delta is the direction and probability. So how likely a stock is to make the move that the option is paying for is your delta. And then gamma is the rate of change. So you'll hear things like a gamma squeeze. That's when like an option usually goes in the money and a lot of people have bought that option and now the market makers have to buy a lot of that underlying shares and stock to make up for that fast change. And that's where you get big moves like we saw in GameStop and AMC back in the day. And recently saw Car, Avis. Those were gamma squeeze moves usually. So if you understand the Greeks, definitely help you control the game here. Quick little deep dive on each one here. So with Theta, every day counts. Options lose value as they get closer to expiration. You'll notice when we're buying swing trading options, we're usually going at least a month or two out. And when we're buying day trading options, we're going same day. We don't care about that. But the value erodes even if the stock price doesn't move. So if the stock price stays the same, the value can go down. And the closer to expiration you get, the faster time decay is. So that's why it's kind of good to sell short-dated options because you can make that premium money pretty fast and easy as that theta decay is fast. Vega, volatility can definitely make or break a trade. Different volatility give you different options pricing. So the higher the VIX is, you'll typically see higher options pricing as the VIX goes up. Options become more expensive, prices go up. I remember when GameStop was squeezing, since we were just talking about that gamma squeeze, I remember I bought a put on it at $40 and GameStop was like around $40. And GameStop went up. So the price went against me, but my put option actually went way up in value because the volatility of the stock was increasing so much. It was going so wild that everybody wanted every option for it. So, and it matters because, like we said, you can be right in direction. If volatility drops, you can still lose money. But also, you can be wrong on direction and volatility increases, you can still gain money. So that's kind of a cool part. It works both ways. Options are definitely a double-edged sword. Delta measures how much an option price moves when a stock moves. So calls have positive delta, puts have negative delta. When the stock goes up, the call option price tends to go up. When the stock goes down, the put option price tends to go up. Delta ranges from -1 to +1, and the closer to 1, the more sensitive the option is to price movement. So if you have a delta closer to 1, as the stock moves, the option will move a lot. If you have a very low delta closer to 0, the underlying, the stock can move a lot, and the option price still won't move that much until it gets higher delta and closer to in the money, things like that. So delta is like your movement sensitivity. It's also like your perceived or assumed percentage of chance of success with that. That makes sense. I'll dive deeper later. I'll sweat it. If it does not make sense, I will dive deeper. Don't sweat it. Gamma is the acceleration. So how fast things can get pretty crazy here. So price moves, the option moves. As that option gets in the money, that gamma increases, and near expiration, 0 DT, that gamma can go wild. So when you have a lot of people who are heavily positioned, so say in Tesla, let's say all their options expire today, and those calls that expire today go in the money, that can really send Tesla flying back. Small moves can lead to small gains, but big moves can lead to explosive gains. And good point here. This is why 0 DTE can print fast, but it can also kill you faster. Actually holding some 0 DTE puts right now. We'll see how those play out today. But as I stated before, options really are insurance when you're buying them. I mean, we trade them. So if you could trade insurance contracts, you probably could do that too. But you're paying a premium for the right, not the obligation, right? So insurance for your house is you pay a premium. Options for your trade, you pay a premium. Insurance for your house, you're covered if something happens. Options for your trades, you're protected if the market moves against you with things like the fact that you can't lose more than spent, or with things like if you own a bunch of a position, you buy puts, you can make money when you go down, etc. So the insurance for your house helps you sleep better at night. The options for your trade should give you a certain peace of mind if you're using them. And the powerful benefits of options are you can define your risk. So with a house insurance payment, you're defining your risk. All you're going to pay is that insurance, maybe a deductible, which I know because my house has been destroyed in a fucking hailstorm, but you might pay a deductible as well. With options, there's no deductible, don't sweat it. But unlimited potential, so huge upside. So if your house burns down, you can make all that money back. Just kidding. Um, control without or control with leverage. So you control 100 shares without having to pay for 100 shares. You control the fact that you give them your house if your house burns down without having to just own a second house, right? And then flexibility, you can use options in any market. So it might be, it's way less dangerous to buy a put option in GameStop when it was $40 when the float was tiny, or AMC when it was $1, float was tiny. Than it is to short the shares there, as we saw with those short squeezes or with the car short squeeze recently. If you short the shares, you have unlimited loss potential. Same if you kind of buy the shares, you have a big loss potential because those shares can go to zero. With the options, though, the price that you're paying is much smaller than what you are potentially risking if you did it the other way. Flexibility, you can use them in all markets, and peace of mind, you have a plan to find risk and a clear exit. So the most you can lose is the cost of options if you're just buying naked options. So nothing, no need to figure. All right, now why guidance matters. It is tricky at first, especially choosing the right combination, choosing the right put or the right strike and the right expiration or the right spread or the right call, knowing how long you need to go out in expiration, knowing what strike you should purchase the call or put at. On top of that, you already have to know the ticker and your charting and have the right setup and have your chart set up and know the probabilities, etc. So having a mentor or a system really can save you in these instances, and that's something that we provide at Pitbull Capital. Link in the comments, probably in her chat or whatever the fuck's below or saying. Shameless plug. But that does help save time, definitely helps save money, avoiding costly mistakes. And a lot of what I teach and what I give away and what I try to share with people is stuff that I just wish I had when I started. So I didn't make a bunch of mistakes and lose a bunch of money to get started. And I could have just been off to the races and purely profitable and successful from the get up. But having a mentor will save you time, money, and stress. So I highly recommend it. Not just any mentor, though. I see people in like Facebook groups on Reddit. What should I buy? What should I buy? And so many, everybody's an expert and everybody's an idiot, honestly. So many people with such bad advice. So find somebody you can trust with a good track record. So here's a good comparison. Same stock, same idea, different contracts, different results. So a cheaper option has a lot of risk, needs a lot of work. So NVIDIA, a 950 call, 0 DTE, price paid 35. NVIDIA was a much different price. So it's cheap because it's pretty far out the money. There's not much chance, low probability. It makes it very cheap. Low chance of it happening, not much reason to sell it very expensive. So we would need a huge move for it to pay out. Typically with a move like this or with a far out of the money, same day expiration contract, you're going to lose and it will expire worthless, 100% loss. Very common instance for a lot of traders here. Versus same thesis, same stock, different decisions, different outcomes. This is where having a mentor or a strong system in place can really help. But better structured option here gives the trade room to work. So same ticker, NVIDIA. This time the call is 880. We'll assume that NVIDIA must have been somewhere around 880. So very little chance for it to get to 950, strong chance for it to end somewhere in this mix here. Expiration 7 days away, much more time than expiration same day. And you'll see though the price, you have more risk because it costs more money. So you are risking more money for higher chance of winning. So closer to at the money gives you a higher chance of profit. More time gives you more time to profit. This gives you higher probability, so the market expects to move in the right direction, and manageable gamma for a smoother ride, less all or nothing. And this one you would have bought for 420, it sold for 630, and made $210 or a 50% win. Very fast, very nice. This is why most traders lose, though, is because they're picking the wrong contracts. Even if they have the right ticker, if not, they're picking the wrong ticker, wrong contract, wrong strike, wrong expiration, etc., etc. Our alerts will definitely give you an edge here. So cheap options, high reward, but high risk. So this is a way I do use cheap options, but it would be on a stock like AMC or something, Beyond Meat, something that has potential to probably go to very little, very risky stock. A lot of small caps can be fun here. Like Teladoc is a $5 stock right now. Do I want to own 1,000 shares of Teladoc for $5,000? Probably not, because it's pretty risky. It has a low PE. It's kind of a value. Long story short, but um, maybe not as risky as some. But let's just say they could file bankruptcy tomorrow and it goes to zero, or lose that $5,000. You could probably buy 10 options contracts, which would give you the leverage of the same 1,000 shares, and you could buy those options contracts that expire months and months out. So it gives you several months of leverage for a couple $100, and that way, um, with a cheap option, I'm risking a couple of hundred instead of risking 5,000 on small cap. But lots of good ideas here. It's funny that they put these tickers here. They had AI make this thing, and those are all tickers that we traded long back in the day on some sweet, fun short squeezes and made tons of fucking money on gamble squeezes there. But AMC, great example, went from $2 to 72 in days. I was one of the few people calling to buy at $2, and made a lot of people a lot of money. Contracts that were worth 10 cents quickly went to $5, 50x return on investment there. So if you put $1,000 in, you made 50,000 back. That was just an awesome freaking time for our group. We did great. What happened to a lot of amateurs, though, they kept gambling, that addiction, that addictive part I was talking about in the beginning. They gambled, they saw that big return, and they wanted more of that big return. They kept buying and buying and buying as it went up and up and up. As it's going up, the premiums are getting higher, the strikes are getting higher. And if you just kept flipping and reinvesting every dollar that you made in there, eventually AMC came back down to earth and you would have lost it all. So the smart ones, most of us that were trading that together at the time, took our money and ran for the hills. So the risky part is lower probability on the cheaper ones. They need big moves, time decay can kill them, and mostly expire worthless. So amateurs gamble on the cheap options. Professionals understand the odds and use these for a logical and profitable way to manage risk, hedge risk, understand odds, and play to win. So expensive options are the opposite. So you have a higher probability, more time on them, more control. So I just alerted some options on Walmart yesterday. Cost $500 per contract. Walmart's barely up today, but they're already up a little bit on the contract. So, you already made $50 out of that. You can sell them real quick. Even though it doesn't expire for 2 months, we can sell them today and just take our 10% return overnight and be happy with it. A lot of people will. So the benefits of the expensive options are much higher probability. The strikes are usually closer to where it is, and they give you more time to work. So you might be wrong today or tomorrow, but you might be right in a week or two. They give you more consistent results, better risk management, better win potential. So with our pit power plays, this is what we're typically focused on: longer dated options, a little bit more expensive, but much higher probability, and a great way to use leverage and get time and some flexibility on your money here. So real example, NVIDIA, that 7-day call that we use, 880, alerted at 620 at the high. It went all the way up to 1840. So your results there would have been almost a 200% return. Higher probability equals more wins. So the risk of higher costs and expensive options are the higher costs. You're risking more capital up front. You lose more if you're wrong. So if it does never happen or never go your way, even with all the time you buy, you can still be wrong and still lose. Still not a guarantee, just a higher probability, but not a guarantee. And drawdowns can definitely be larger because you're risking a larger amount of money. It's all logical. risk more, but you get paid more when you're right. So experience knows when to pay more and when to play cheap, and that's what we really have. That is the pick advantage. We pick the right contract for the right situation. Amateurs focus on price, we focus on value. So cool part about options, various different ways that you can use them. You can use them to control your risk, but you really choose your risk, control your costs, unlock massive returns, unlimited flexibility. So defined risk, control your costs, massive return potential. You could sell puts, cash secure puts. So let's use Teladoc for an example. Let's say I want to own those 5,000 shares of Teladoc, so I could sell $5, 10, $5 put contracts, telling someone else I am going to sell them the right to sell me 100 shares at $5 by that expiration. Then, let's say Teladoc goes to $6. Those options will expire worthless, and the premium that I collected by selling them will be in my bank account still. So I will get paid just for being willing to own the shares. That is an awesome way to own shares. If you were ever going to buy shares or own stock in any company, I would sell puts to do it. Any other way is just dumb, in my humble opinion, unless there's no options. Credit spreads, whether you can lower risk. So let's say I want to own those Teladoc shares at $5, but I'm afraid because they got earnings coming up, or because I don't know, whatever reason, I'm afraid that they might go to $2. So I don't want to pay $5 for them if they go to $2. So I can sell a $5 put and then buy a $4 put, saying that I'm buying the right to sell it at $4. I'm selling the right to buy it at $5, meaning the difference is only $1. So I'm only risking $100 for 100 shares, or $1 per share at the most, kind of like a stop loss at the most. And I'd still get paid a premium to do that. Now, the alternate to that would be debit spread. So I could buy the $5 put. Let's say I think it goes down. I could buy the $5 put and sell the $4 put, because maybe I think it's going to go down, but it's not going to go down that much. And that makes it cheaper, because I sold another option in the same direction. It also makes it a little less volatile and higher probability for success, less risk on the line. Debit spreads are definitely a great way to go there. I actually just bought a debit spread in UNH because it looks like it has huge upside, right? But just buying a call because it looks like it has huge upside can be scary or very expensive. So I think a call was like $1,500. I was able to get a spread that's $10 wide for like $400. So I still make 1,000 if it goes up past the higher strike that I sold. And a great way to hedge and protect your profile. Screenshot this, read it over. Options versus stocks versus futures, though. So for stocks, options, lower cost to control the same amount of shares, defined risk versus unlimited risk, more strategies, more flexibility, more money in up, down, or sideways markets. And if you want to compare it to futures, defined risk versus unlimited risk, lower capital requirements, more flexible strategies, no overnight margin risk, and much better for smaller accounts. Bottom line, options give you more flexibility, control, and opportunity than stocks and futures simply cannot match. So the control they give, you're in charge. You choose the risk, you control the cost, you define your risk. Max loss is the cost of the option. You can adjust your cost. You can go farther out, you can go closer up. So much flexibility. That's part of the negative of it, but a huge part of the positive of it, especially if you have the right people in your corner to help you make some of these decisions when you're first getting started. But you can really build the trades around you and your portfolio. One of the reasons I love trading options when I first started trading them, no still, but really when I first started trading was I could really feel like the big guys on Wall Street who were making the big money, who were trading these huge lot sizes. So while they were trading 10,000 shares of Tesla, I could still afford to at least grab a few calls and join in that benefit of leverage there. So flexibility, time, custom solutions, total control. I love it personally. Also, unlimited strategies. I might have had this on there twice, but selling puts, credit spreads, debit spreads, protected puts to hedge, and custom strategies. You can get more complicated with the strategies like iron condors, butterfly, straddles, strangles, and more. I'm sure I'll have plenty of videos going out about those in the future, or I might already have some on here. We'll flick through them. So pit bulls, we trade different. because people are different. So we use all of these systems within our different alerts that we have. We have zero DTE option trading alerts that we use. We have swing trading alerts, power plays alerts that are very high probability that we use. We have credit spread alerts that we use. But this is why we're always able to win, is because we can move and be flexible and disciplined at the same time. These strategies, the experience in the strategies, what really gives us the edge. So what type of trader are you? There's not one way to do this right. There is a right way for you. So maybe you're an income seeker. Maybe, you're doing this for retirement and you just want to make some money while being willing to own some nicer stocks. You think that Apple's a great stock to own. You have enough to buy 100 shares, so you sell puts on it every week until it hits, and then when it does, you own it, but you get income until then. Growth seeker, maybe you want to capture those big moves, but limit risk by buying calls and debit spreads and calendars. Risk management, maybe you have a huge profile or even just a decent sized profile and you want to protect it by using protected puts or put spreads, delta hedging. If you're an active trader and you want to get in our zero DTE options or iron condor strategies, butterflies, calendar spreads, and great for a small account because you can get the same exposure and leverage and gains as the massive accounts, but for a fraction of the cost. So you choose your risks, you control your costs, you can use them in any market, you can use them in any time frame, you can use them with any account size, super flexible. We also have a variety of services and alerts because every trader is different. So we have at Pitbull Capital, we have several different styles of alerts that fit all different strategies, all different types of traders, all different types of goals, experience, etc. So whatever you're looking for, feel free to let us know. We will definitely hook you up. So a couple